Investment planning is an essential component of any financial plan. Long-term investing involves wealth creation, protection, preservation, and consumption. That is, the consumption of wealth during retirement. Wealth creation is the accumulation of wealth through savings and investments. Wealth protection is protecting your wealth by structuring your investment in such a way that you will not lose capital. Wealth preservation is the preservation of wealth through managing your withdrawals in a way that sustain your lifestyle over a planned period. Investment planning sets out long-term strategy which allows you to grow your capital to meet future commitments. In order to grow your wealth, you will need to diversify your investments to achieve different levels of return. The asset classes mainly used are cash, bonds, property, and equities. Secondly, you need to diversify these assets between local and offshore assets. Let us go through these asset classes, starting with cash, which we use daily. Cash refers to short-term obligations that are traded on the money market. It provides a return in the form of regular interest payments and is viewed as a low-risk investment. These investments include fixed deposits and savings accounts, among others. The higher the interest rates, the better the expected returns on cash. The next asset class is bonds. Bonds refer to long-term obligations that are traded in the capital market. A bond is a debt between the bondholder and the bond issuer. The bond issuer issues a bond or loan to the bondholder with an expectation that they will receive interest on this loan over an agreed period. Bonds are usually issued by the government and companies to raise money for investments. The investor is normally paid interest twice a year. Declining interest rates are positive for bonds, while rising interest rates impact negatively on the capital value of the bonds. The next asset class is property. Property is regarded as the classical way to build wealth. It rarely depreciates in value and is a good way to protect your money from inflation. Investments can be made into listed or unlisted property. The return for investors is mainly in the form of rental income, while the opportunity also exists for capital gains. Property is considered a moderate risk investment. Now, let's move on to equity. Equity refers to listed or unlisted instruments that provides you with co-ownership of companies. Returns are received in the form of dividends declared by the company, as well as potential capital gains. When you purchase equity in a company, you gain a percentage of ownership in that company. The amount of ownership is proportional to the amount of equity you own. Positive economic growth increases the demand for goods and services, which improves company earnings and supports equity prices. Now that we have addressed the different asset classes, it is imperative that we understand the concept of asset allocation, which involves mixing the different asset classes with the aim of achieving a specific investment outcome. So, based on the purpose of the investment and your goals, you will have a portfolio consisting of cash, bonds, property, and equity, both local and offshore, which a fund manager will manage within a predefined mandate. An aggressive portfolio with a higher equity exposure will offer the highest potential for capital growth required for growing capital and beating inflation. However, it is associated with higher investment risk in the short term. A balanced portfolio provides a trade-off between achieving inflation-beating returns at an acceptable level of investment risk. A cautious portfolio offers lower invest return but has a higher liquidity. Diversification will help manage and reduce investment risk. These portfolios normally range from cautious to aggressive portfolios. Finally, it's important to understand the relationship between time, risk, and return. The rate of return you achieve will be based on the amount of risk you are willing to take. The higher the return, the higher the risk usually associated with it. Additionally, the higher the required rate of return, the longer the time period is required to reduce the investment risk.